Well, I think when people say it's hard to do something, it's often because they don't have the experience or the example of understanding how to do it. So we could say it's really hard to be a neurosurgeon unless you know how to do it. So I think the learning is in the doing, and a lot of groups either don't explore and take the time and the discipline to actually get some on-the-ground experience with measuring impacts. They kind of take what's out there, and there's not a lot out there that's been proven and in operational use for them to use as living examples, and so they default back to what they know and what's easier to communicate and use as an operating conceit. So if we think about social impacts, I'll give you a very simple rubric. Everybody understands the use of a balance sheet from a personal perspective, and the discipline of a balance sheet is simply, I want to improve my assets and I also want to eliminate or decrease my liabilities. It's a very simple construct. People understand that that's the way to personal wealth. Well, it's also the way to social impacts. Either you're helping somebody improve their assets and or decrease their liabilities, and that's either behaviorally or in terms of some condition or circumstance that they're confronted with. And if we look at those balance sheets as one individual at a time in communities, in organizations, even across entire demographics, it's easy to agree and verify whether or not a domestic violence situation has abated. Either the man's stopping and he's not beating the woman anymore, or he isn't. Either the child can read on grade or they're not. Either the homeless person is off the street or they aren't. So it's really that simple, and I think we try to make these externalities so much more complex and systemic before we even have the basic elements operationally working on the ground. And I think that's where the error has been, is people are trying to approach it from too much of an abstract theoretical level as opposed to just making it work as an operational framework.
When we evaluate the social impact component of a particular investment, I would love it if they would understand what we do. We actually look through to see how that enhances the financial return. What I'm referring to is essentially reducing risk, reducing volatility. Where we provide financing, it's typically for, as I explained, financial institutions that are providing in turn microloans, SME loans, savings products, other things that low-income, excluded populations need for their livelihoods. This type of livelihood financial service represents a much more reliable relationship with a client than I think normal banks have with, say, normal clients out here on the street, in the streets of any American city. When you reduce risk because the client really believes in the loan and uses it for productive purposes, then you've built in both the means and the motive for them to repay. And that becomes a more reliable income stream. And we find, therefore, the social impact and the financial side are self-reinforcing. The highest quality standards in both lead to the highest quality investments.
That's a good question, because now we have crowdfunding, which means everybody can now invest for equity. There are some requirements. It's just starting here in America where you can invest for equity as opposed to a gift like Kickstarter. But crowdfunding is changing the landscape for all angel investors. And what we're seeing is a lot more of the traditional angel bulletin boards and angel companies are now approaching crowdfunding. So for instance, my company, Go Beyond Investing, allows other people to invest with us. There are a number of companies here in America, starting with AngelList, which also allow people to invest with them. There's pluses and minuses that go with this new development. One is it's a regulated development, so the regulations determine to some extent who can invest and what kind of investments have to be made and what kind of regulations the entrepreneur will have to follow. But it opens up the playing field to the average American to invest in any, I should say the average person worldwide, to invest in any company that they choose to invest in. So that's the biggest trend that I see happening.
Well, a lot of what I heard when I initially started to bring it up to my clientele especially local clientele, were, you know, first of all, what is that? And I mean, isn't that for, you know, environmentalists? Or there was just this interesting perception that, you know, it was a very strict criteria and that you had to be, I guess you had to be a kind of a progressive pioneer in that area to really even be able to participate. But my message to them is, you know, again, social responsibility and sustainability is really something that's, you know, unique to each individual. So when I'm talking to my clients or I'm talking to someone and I ask them, you know, are you interested in socially responsible investing? Many times they say, oh no, you know, I don't think so. And you know, I ask them then, well, you know, if you had your choice between a company that was treating their employees well and all other things being equal, and a company that wasn't, which would you prefer? Well, of course, you know, I would want the company that treats their employees well. Okay, well, you know, if you had a choice between a company that allows child labor and you know, sweatshops, or a company, again, all things being equal, or a company that doesn't allow those practices and doesn't have those practices, which would you prefer? Well, of course I don't want children work. Oh, that's terrible. Well, okay, then guess what? You're really, in the broadest definition, a socially responsible investor. People are so thankful and really, they just never knew they had that option. I mean, I want them to know that is an option, and it's a great option because not only do you get to invest according to your values and feel good about what you're doing, but you can actually make more money doing it.